In this video, we are going to talk about 10 dividend stocks to buy and hold forever. So before starting this video, please like this video and subscribe to this channel for our future updates. As 2020 began, it looked as if the long era of rock-bottom rates might finally come to an end. But the pandemic quickly threw a wrench in that outlook, as the unemployment rate soared from 3.5% in February to 14.7% in April, and the Federal Reserve slashed interest rates to zero in March. The 10-year Treasury yield has been less than 1% since March as well, and income investors once again have few attractive options. With that in mind, we are highlighted 10 of the best dividend stocks to buy forever, with yields that range from less than 2% all the way into the double digits. Here are some of the top dividend-paying stocks to buy for the year ahead. Before we begin, why don't you hit the subscribe button and the bell notification icon so that you never miss any of our videos. Let's begin. Number 10. Novartis, ticker NVS. It has been a volatile year for many healthcare stocks, with some companies soaring based on potential related to the pandemic and others suffering amid economic uncertainty. However, Swiss drug maker Novartis stands out with bright, long-term prospects thanks to its diversification. NVS offers a wide array of treatments for a host of diseases, across skin conditions, cancers, neurological disorders and a wide variety of other chronic ailments. Novartis admittedly only pays dividends once a year, but that shouldn't matter when your holding period is forever, and with a robust product pipeline alongside a stable of proven moneymakers, the future looks very bright for this healthcare play beyond the fad of pandemic investments in 2021. Number 9. National Health Investors, NHI. A twist on the reliable business of healthcare as medical real estate firm National Health Investors. NHI specializes in financing solutions across the sector, largely focusing on senior housing facilities and retirement communities. It also includes hospitals, medical office buildings and other sites. Nothing is more certain in life than getting old and needing more care as we age, so the result is a reliable stream of cash to fuel generous and reliable dividends from NHI that will withstand the test of time. As proof, while some medical real estate plays have cut their dividends lately, NHI actually increased its payouts from $1.05 to $1.10 per quarter in early 2020. Number 8. PepsiCo, PEP. Another of the best dividend stocks to buy forever is beverage and snack giant PepsiCo, a company with impressive diversification across geographies and business segments. In the 36 weeks that ended September 5, Pep's Frito-Lay North America division made up 26.6% of total revenue, not far behind its PepsiCo Beverage North America segment, which made up 32.9% of the top line. A dominant food and snacks division is something its biggest rival, Coca-Cola Co. lacks. And while Coca-Cola saw EPS fall 33% last quarter, PepsiCo's EPS actually advanced 10%. Pep pays a 2.8% dividend and is up about 6% in 2020 versus Co's roughly 4% decline. Number 7. PetMed Express Pets. Another very different take on healthcare is this smaller and pet-focused offering, PetMed. Though selling heartworm and flea medication is not as glamorous as treating cancer or developing a cure for Alzheimer's disease, investors should be interested in pets for its dominance in the durable and fast-growing category of pet expenses. While Wall Street has really fallen in love with this stock this year as it has been growing rapidly, this is not a flash in the pan stock. Reliable revenue fuels dividends that have surged from 18 cents in 2016 to 28 cents a share presently, more than 55% growth in just under 5 years and an encouraging sign of future income potential. Whatever the future holds, you can be sure there will be pet owners in it. That's good news for PetMed and its shareholders. Number 6. Amcor, AMCR. While online merchants such as PetMed have seen their day in the sun in 2020 thanks to social distancing, the reality is that more dollars are being spent digitally every year. Consider that in 2019, total e-commerce spending in the US was up about 15% over the prior year, while overall spending and gross domestic product growth were in the low single digits. You can pick and choose individual merchants if you want to really cash in on this growth trend, but that's risky, and besides, most high flyers like Amazon.com, AMZN, don't pay a penny in dividends. A lower risk, long-term play on this trend is packaging giant AMRC, which makes all manner of containers that allow e-commerce businesses to thrive and ship their goods intact. It's not as high margin as selling a TV or a mattress online, but it's certainly more reliable as evidenced by a steady stream of dividends. Number 5. Verizon Communications (VZ). Speaking of the internet, the only way you can have reliable connectivity to buy anything is through a key telecom provider such as Verizon. Its 5G, or fifth generation, wireless network continues to grow impressively, with about 35 metro markets covered at present. The company's core wireless business also continues to dominate as the largest network of subscribers in the US. On top of that, its Fios fiber optic service for homes and business is growing strong. Thanks to its investments in network quality, VZ will remain a force for many years to come. And as long as customers keep paying their bills, that will result in a reliable income stream for shareholders. Number 4. The Coca-Cola Company Co. Coca-Cola is one of the largest beverage companies in the world. Its products are sold in more than 200 countries globally, with over 500 individual brands in the company's portfolio. Coca-Cola has a portfolio full of category-leading brands in both sparkling and non-sparkling beverages. Just a few of its premier brands include Coca-Cola, Diet Coke, Sprite, Dasani, Minute Maid, Simply, Gold Peak, Honest Tea, and many more. Coca-Cola's operating margin actually improved to 26.6% for the quarter, from 26.3% in the year-ago period. The company's ability to keep margins afloat helps it to remain highly profitable, even in a difficult climate. Going forward, Coca-Cola has the potential to return to growth, as the global beverage industry still offers opportunity. Soda consumption has declined in the US for over a decade, which is a lingering headwind. But Coca-Cola is responding by investing in adjacent categories such as coffee. Coca-Cola stated at the time of the acquisition that the global coffee market was growing at 6% per year, and Costa has operations in more than 30 countries around the world. Coca-Cola stock yields 3.3%, and the company has increased its dividend for 58 consecutive years. Number 3. Lockheed Martin LMT. Lockheed Martin is the world's largest defense company. Its largest customer is the U.S. Department of Defense, which represents 60% of its revenue. Its other customers include international government agencies as well as other agencies within the U.S. government. Lockheed Martin had nearly $60 billion in revenue last year. The stock has a market capitalization of $103 billion. The company consists of 4 business segments. The largest segment is aeronautics, which represents approximately 41% of the company's sales and consists of military aircraft like the F-35, F-22, F-16 and C-130. Next is the rotary and mission systems segment at 26% of sales, and includes combat ships, naval electronics, and helicopters. Number 2. Colgate-Palmolive Co. CL. Colgate-Palmolive was founded all the way back in 1806. Today, it is a consumer staples giant that sells its products in over 200 countries around the world. It operates in 4 core categories: oral care, personal care, home care, and pet nutrition. The company's most recognizable brands include Colgate, Palmolive, Soft Soap, Ajax, and Hill's among others. Colgate-Palmolive dominates the toothpaste market, with the number 1 global position. Colgate holds a 40% share in the global toothpaste market. With an annual dividend payout of $1.76 per share, Colgate-Palmolive is expected to have a dividend payout ratio of approximately 60%. This is a healthy dividend payout ratio, which gives sufficient coverage of the dividend while leaving room for additional increases each year. Colgate-Palmolive stock has a 2.2% dividend yield. Although it does not qualify as a high-yield stock, Colgate-Palmolive increases its dividend reliably every year like clockwork. And, the yield still beats the average S&P 500 index yield, currently around 1.7%. Number 1. Chubb, CB. Speaking of less risk, Switzerland-based insurance giant Chubb is in the business of managing risk via its policies that cover residences, automobiles, businesses, boats and a host of other assets. With more than a century of operations under its belt, and more than a century of dividend payments, CB knows a thing or two about how to cover the costs of claims and still have plenty left over for its shareholders. Though not a household name, this nearly $60 billion financial company offers a dividend that is sure to stick around and even grow considerably in the years to come. What do you think of our list? Which of the above dividend stocks you want to buy? Let us know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button and turn on notifications before you go. Thanks for watching.